one sector will be firmly in the spotlight in the coming week, as no fewer than 4 major companies in it will report their full year results. That sector is utilities, and the quartet in question comprises Pennon on Tuesday the 21st of May, Severn Trent and SSE on the 22nd, and National Grid on the 23rd. Now, over the past 12 months, gas, water and multi-utilities ranks 28th by performance in the FTSE 350 out of 39 different sectors, and electricity ranks 29th, so neither is really setting the world alight, and that may be for the following reasons. First, investors are awaiting regulator Ofwat's final decisions on the AMP8 regulatory cycle that runs from 2025 to 2030. The preliminary response to the water utilities pricing and capital investment plans is due in June, with a final determination in December, ready for implementation next April. Second, the stink caused by Thames Water is leading to fears the regulator will play hardball. Severn Trent raised £1 billion via a rights issue in 2023, and both this company and United Utilities have already accelerated capital investment at the end of AMP7 in preparation for the AMP8 regulatory cycle. The question will be what they're permitted to do with prices and what return on investment they are allowed. Third, there is a general election looming, and utilities could therefore become a bit of a political football. Remember that one of the Labour Party's first actions when Tony Blair became Prime Minister back in 1997 was to impose a windfall tax on utilities profits, so the imminent campaign could, in theory, again see this issue come to the fore. Some analysts argue that National Grid, however, may be less exposed to any political shenanigans, as around half of its assets are now in America. And finally, utilities yields have looked relatively less attractive at a time when the Bank of England base rate has reached its highest level since 2008 and dragged bond yields higher for good measure. In simplistic terms, utilities are often seen as bond proxies. The rule of thumb is that when bond yields are falling and prices rising, utility stocks do well, as their yields look relatively more attractive, and that the utility stocks do less well when bond yields are rising and prices are falling, as the equity yields look relatively less attractive. There's also the issue of dividend growth to consider. SSE's full-year dividend for the year to March 2024 is expected to be 60p a share, down from 80p last year, as it invests heavily in renewables. Pennon, National Grid and Severn Trent are all expected to grow their payouts in the year just ended, and indeed in the year just begun to March 2025. Now, at the time of writing, Severn Trent's dividend yield for the year to March 24 is 4.5%. That's a premium to the FTSE 100, beats the prevailing rate of inflation and the risk-free rate as benchmarked by the yield on the UK 10-year government bond or gilt, and it's based upon management's guidance for a dividend per share of 116.84p a share, compared to 106.82p in fiscal 23. Nevertheless, the shares are down by some 10% over the past year, even as the FTSE 100 has finally moved to new all-time highs. Analysts and shareholders will therefore look to Chief Executive Liv Garfield as much for guidance for the 2025 fiscal year, the last one of AMP7, as much as they will for comment on the 2024 year just ended. Now, the current guidance from management for 2024 is as follows, and they set the base for fiscal 2025. An increase in sales of between 7.5% and 10% from the regulated water and wastewater businesses. Higher operating costs thanks to upward cost pressures from pay, energy, and more investment on how to stem flooding. Higher profits from property sales and a largely flat contribution from outcome delivery incentives of at least £50 million, as Severn Trent outperforms regulatory requirements. Watch out also for any comments on customer bad debts. A lower interest bill compared to last year's £363 million, although the lack of rate cuts in the Bank of England could be a stumbling block going forwards. A big drop in the tax rate thanks to tax breaks for higher investment, and all of that combination underpins analysts' forecasts for an increase in stated pre-tax profit for the whole fiscal year to £229 million against last year's £168 million. Note that analysts expect a big advance in fiscal 2025 to £363 million. Another big number to watch is capital expenditure. We've already hinted at this. This peaked above £800 million as Severn Trent got ready for the end of the AMP6 cycle and came in at £737 million last year. However, the budget for this fiscal year lies in a range of £850 million to £1 billion as the FTSE 100 firm again readies itself for the end of AMP7 and the start of AMP8. And analysts have actually estimates now sit at the very top of that band, and they go higher again in 2025. I hope that you're all well and in good spirits. Thank you for watching, and I look forward to seeing you again next time.